Hey guys, let's see. Okay, seems like we are back. Seems like we are back. Seems like we are back. So without wasting any time, let's get to it. Let's get to it. So the second part of the lesson now, since you were able to identify the impulses and corrections, right? Since you're able to identify the impulses and corrections, the second part of the lesson now for you will be how to draw trend lines, right? The second part will be how to draw trend lines, how to draw trend lines. So basically what we do here, right? We don't just draw trend lines because we want to see the trend of the market. We don't say, yeah, the market has broken out of the trend line, we're going to buy. We don't, you understand? We don't say, okay, let's say, for example, let me just do this, remove everything. Let's say, for example, we have something like this of a sort, and then this, and then this. So usually trend line traders depend on the trend lines to say, trend line traders depend on the trend line to say, now it has broken out of the trend line, now I'm going to buy. You're going to buy until the top, you understand? So that is not how we use trend lines here. How we use trend lines, we use trend lines as a framework to give us the overall structure of the market. So we use trend lines differently. So we use trend lines to give us the framework or the overall direction of the market or the overall structure of the market. Okay. So what we do here, basically, when we draw our trend lines, we always make sure that our trend lines are drawn at the wicks of the structures. They're always drawn at the wicks. Okay. They're always drawn at the wicks. They're always drawn at the wicks. So we will not find us to drawing a trend line like this. Okay. We will not have a trend line like this. All right. We will not have a trend line which is something like this and say, no, that is not how we draw it. Okay. So when we draw the trend lines, when we say we draw them all the way to the wick, is that we basically just connect, right? If you can just see, basically just connect, right? So if it does not connect, then it's not there. If it does not connect, then it is not there. You understand? So that is basically what we do. This is how we draw. This is what we use trend lines for. This is how we draw the trend lines. We just connect those wicks. Okay. So now you see, when we're starting to connect those wicks, now what do you see? You see we are starting to form structures, right? We're starting to form structures. When we are connecting those wicks, we are starting to form what we call structures. Okay. We are starting to have structures. That is what is happening now. That is what is happening. So remember, this is the monthly time frame, but this applies on all time frames in terms of drawing your trend lines. Okay. It applies on all time frames. It applies on all time frames. So what you can see here, let me just bring this one forward like so. So from here, what you can see, we had a reversal correction, this impulse correction, impulse correction, impulse. So that is how the market moves. That is how the market moves, you see. So now when you have drawn all those structures, you can see how the market is. So this applies on all the time frames. This applies on all the time frames, all right? This applies on all the time frames. So even if I go to the weekly time frame, for example, let me just head down to the weekly. So if I go to the weekly and say on this string, I want to identify the impulses and corrections, right? So I'm going to find impulse correction. This is to be correction. And then we had that large impulse up, and then we had an impulsive move down, correction, impulse, correction, impulse, correction, impulse, correction, impulse, double bottom, then impulse, correction, impulse, correction, impulse, correction, impulse. So you understand? So that is basically what it is. So when we come here also on the weekly, we have those structures that you can see. Okay, we have the structures that you can see. So even if I do like this here, I have a falling wedge. Remember what I said, all the way to the wicks. So look at how I draw my structures, right? You don't see my trend line. You don't see my market outside of structure, right? That is one thing that is very important. That is one thing that is very important. So if it's not there, it's not there. Don't force something. If it's not there, it's not there, okay? If it's not there, it's not there. So don't try to force something which is not there, right? Don't try to draw a trend line and say, no, you know what, it's like this. No, no, no. Don't try to force things that are not there, guys. That's one thing I always say. So when you draw your trend line, it will, of course, give you how the market is. It will, of course, give you, okay? And also, it's not just a matter of drawing trend lines all over your chart. It's not just a matter of drawing trend lines all over your chart. It depends on where the market is and what you're drawing the trend line for, okay? So basically, when we draw trend lines, we use them to identify structures and patterns. We use the trend lines to identify the structures and patterns. So you don't just go randomly drawing trend lines to say, yeah, this is up, this is down. No, we use the trend lines to identify those structures and the patterns. So the most important tools that we use on our strategy is the trend line and the ray line, okay? The most important tool that we use is the trend line and what? And the ray line. Those are the two most important tools that we use. That is the trend line and the ray line, okay? The trend line and the ray line, okay? So this is the ray line. So with the ray line, basically what we do, you just go to identify the highs and the lows. That's it. That is the ray line. And then the ray line, again, you can use it again to identify correctional structures that are yet to form or correctional structures that are going to form, okay? And then also the ray line can help you to identify the zones where you expect the market to reverse, right? So let me just do this. Let me just do this. Okay. So let me show you something here. So what we have here on these ray lines of ours, when you can see this is the previous market and this is the current market. So what we are waiting for basically is that when the market comes, let's say this is the first ray line here, and then we have a market going down here. And then when this market comes up here, this is where we're expecting to do what? To sell the market, right? We're expecting to sell the market, right? We're expecting to sell the market from this ray line. But then obviously, looking at the way the market is here, obviously we're looking to buy. But what I'm saying is on these ray lines, these are our important zones. So when the market was still bearish, this is where we'll be expecting to sell the market. But the moment the market broke out of this one here, it broke out of this one because as you can see, it failed to create a new low here. And then obviously that's why we're expecting it to break, because after all, you need to understand the market structure, right? You need to understand how the market moves. You can see higher low, lower low, right? Higher low, lower low, higher low, lower low, higher low, lower low. So here after this lower low, you're expecting another lower low. So when this market failed to break this lower low and it create a double bottom, that is a sign for you to say this market is going to move back because it failed to break this lower low. After that, you get the impulsive move. After the impulse, what do you expect? A correction. So that is the nature of the market. After the impulse, you expect the correction. That is the nature of the market. So on that correction, that is when that now you'll be expecting the market to continue moving to the direction of the impulse, right? So now another thing that is important to understand, guys, is that the fact that it's a correction, it doesn't mean that all the corrections, you must just go there and sell and do like that. You understand? You have to understand that there is what we call a reversal correction and a continuation correction, right? So a continuation correction, that is one correction that we're going to find somewhere in the middle of the trend, right? To say the trend is continuing and continue with the trend. And a reversal correction will find it at the end of the trend or at the end of the structure to say that the market is going to reverse. So for example, what am I talking about? All right, let me just do like this. Let me have a structure like this. Okay. So we can all agree that here we have a structure which is a falling wedge, right? Which is a falling wedge. And then here on this falling wedge, we have the 1, the 2, the 3, which is the most important. Remember, we need at least 3 touches to say the market is going to reverse. There is an 80% chance that the market reverses on the 3rd touch. But it's not just about looking at the 3rd touch, it's about what happens at the 3rd touch, right? So when we can see here the market coming into the 3rd touch, the market is no longer impulsive, then it reverses. Then from there, it goes up, right? This is on the 3rd touch, it goes up, right? And then coming here, still on the 3rd touch, you get what? A double bottom. You get a double bottom. Right here on the 3rd touch, you get a double bottom. So that is very important. That's another signal. You get a double bottom. And then after here, you have this daily rejection candles. If we go inside here, we're going to find reversal structures, right? Let me just do this. Let me just do this just to show you exactly what I'm talking about. Okay. So when we go here, we go to the 4-hour. Want to see what is happening here, right? So what we can see here, obviously, this was the reversal, right? This was the reversal that caused the move to go to the upside. So what we can see here is that, look at this. Look at what we have here. Just inside here, right? Coming to the 3rd touch. So we have, obviously we have here, we have the 1, we have the 2, we have the 3. And then this again, it's a falling wedge, right? It's a falling wedge, right? It's a falling wedge, falling right exactly at the 3rd touch. And again, what is it doing? We are getting, again, it's at the double bottom area, right? It's at the double bottom area. And then after that, guys, this thing is simple. After that, as long as you understand the movements of the markets, then the rest will be history. So after that, guys, what we have here, we have the market going up. And then look at this. You can argue that this year, we have an inverted head and shoulder, right? We have an inverted head and shoulder right here, again, at the end of the structure. Now we have 4 confluences. We have the, we have the double bottom, which is at the end of the structure. We have the 3rd touch on the higher time frame. We had 3 touches on the lower time frame. We have a double bottom on the higher time frame, and then you have a head and shoulder on the smaller time frame. So you can see that everything is just coming up together to say, Emun, buy me. You understand? It's just saying buy me. So you have all these confluences, right? You have all those confluences that the market gave to you. You have all those confluences that the market gave to you. So you as a trader, it's not a matter of just because it goes here to the 3rd touch, you're going to buy. You understand? Yes, it can buy like this, but what do you want? You want the move. You want this. You want this. You understand? You don't want this. You don't want to be trapped in here, because in here it will frustrate you. It will be positive, negative, positive, negative, positive, negative. It will frustrate you. So you want to be able to catch the moves to the upside. So from here, guys, what you can see again now, when the move breaks out here, I want you to look at something. This is simple market nature. This is simple market structure. If you understand how the market moves, then you know. So guys, as you can see how the market is moving here, let me just get my path right there. So we can see how the market is moving. higher highs, lower highs, lower lows, lower highs, and lower lows. So this is how the market was moving. And then when you look at it here, now, boom, all of a sudden the market broke out. That the market broke the previous higher low, right? So what we can see here from there, when the market broke out also the previous higher low, it is breaking out of structure. It is breaking out of structure. So what we expect when the market breaks out like this, it broke out of structure, it says to us, this again is a signal to say we are ready to move to the upside. So, but it does not mean that you must come and buy exactly here. You must wait for that pullback. You must wait for the market to give you signs to say, this is where you should buy. Then as a trader who knows how we trade, you know that after an impulse, you are bound to have what we call another correction, which will give you a continuation to the upside. So as we can see here, when the market impulse out here, it impulse out, and then what do we have? Let me just take this one back. This one is ugly. It's here. Okay. So this is what we have. So when the market impulse out, when the market impulse out, we have this correctional structure, right? We have this correctional structure which formed. So we have this impulse, and then we have this correctional structure at the outside, at the double bottom, and again at the inverse head and shoulder. So this structure for us is to say is going to continue. And then inside this structure, again, what we have, inside this structure, what we have, let me just remove let me just remove this. All right. So inside this structure, guys, what we have, it's something. So also inside this structure, what we have the impulse, we have the correction, and then we have the impulse, and then what we have again? We have this beautiful, beautiful correction right there, of which also inside we have the impulse and again a small correction. So the market always gives you a lot of entries. You understand? So your entry, right? Your entry 1, 2, somewhere here, right? This was going to be your entry somewhere here. And then obviously entry number 2 after this correction, this will be your entry, impulse, correction, entry, third touch, impulse. And then from this impulse, you wait for the market to form. You wait for the market to give you direction, right? You wait for the market to give you direction. So that is what happened here. We had this impulse, and then after that, the market gave us a correction, right? And when you look at this correction, this is an ascending correction, and ascending correction must break to the downside, obviously. Then 1, 2, 3, downside. Impulse in the form of a correction again. All right. Then downside. And then again, what do we have? Impulse again in the form of what? Of a correction. In the form of a correction again. Right? Excuse me. So this is, and when you see this move is going to the upside and it's just moving correctively to the upside. So this can now say, you can now say that as you can see how this move is moving, you can say how this whole move, the way you are seeing it, is a correction, because you can see how this move is moving. It's a correction. It's moving to the upside, but it's moving in a very, very, very corrective manner, in a very corrective manner. So you can see it's a correction. So if you go to the higher time frame now, let me just go to the daily time frame. For example, weekly. There we go. So when I go to the weekly time frame, what do I see? I see that we have the impulse, and then we are in a correctional phase. So that is why on the smaller time frame, you are seeing a lot of correctional structures. You understand? Because we are in the correctional phase of the market. We are in the correctional phase of the market. So that is what is happening there on the market. So you can see that here you have this impulse, and then we have this correction that we're waiting to see what is going to happen, right? So it's either we get this move and then a move to the upside, or we bounce here and then continue to the upside. So that's basically what we do. So when you find those impulses and corrections will be everywhere. And remember, guys, one thing that you must know is that in impulses, there can be corrections, and in corrections, there can be impulses. So you need to be able to identify and scale out which one is an impulse and which one is a correction, which one is a corrective phase, or which one is in an impulsive phase. All right. So guys, for today, we're gonna wrap it up right here. So what you basically gonna do right now, I'm gonna ask you guys to go and do the work. Remember, do the work. Go and check those impulses and corrections in the higher time frame. And then now for your work number 2, you go and check those impulses and correctional structures, right? You're going to identify impulses and correction first. And then number 2, you're going to identify impulses and correctional structures, right? Impulse and correctional structures. So that is basically what you're going to be doing on your next week. So it means that before tomorrow's class, you must send the work. The work will be checked, the work will be audited, and then after that, that is the admission to your class, right? No work, no class. So for the next class, you get admitted to, and then from there, you submit the work and then you get admitted to the class. So in the next 5 minutes, what I'm gonna do, I'm just gonna open up the session for questions. If you guys have questions based on what we have done right now, okay, not on something that we haven't done, based on what we have done right now, please feel free to raise your questions and then we'll attend to them. Guys, remember, today is just the intro, eh? Today is just the introduction. So that's what we're doing, step by step. There's no rush, step by step. So if guys, if there are no questions, then I guess we're gonna call it a night. It's almost 11 p.m. We're gonna call it a night. Don't forget to do the work. Cheers, guys.
The problem is the Zoom as the app, or like it's not responding, or some things like that. Or it's your network.
The app is the one which was not responding.